welcome back. So now what I'm going to do is I want to introduce our in-house insurance guru, Aaron Porter. Aaron is a delight to work with. He's a wealth of information with insurance. So Aaron, why don't you tell us a little bit about yourself and your background? There you go.
There. How's that now?
A little bit. You're breaking up a little bit.
My name's Aaron Porter, like I said. How about let's just turn off my video so you can't see me, and that might work better.
Sounds great.
All right. So, sorry about that. I'm having some technical difficulties today, but my name's Aaron Porter. I'm the managing head, if you want to call me that, for our Royal Insurance Group here, and I've done just about everything in my life of growing up, and growing up into an adult, which I'm still not an adult, but that's okay. I started out in the automotive field. My dad owned an automotive repair shop since I was in diapers, and so that's where I grew up, and I learned very quickly that there is a specific tool for every job, and because of that, it's helped me in my we'll call it professional career, because I've learned that I'm not capable of doing everything by myself, and even if I am, there's somebody that's probably better than me, and so having that person, having those other people, those other tools around me helps me to be better, and it helps me to better provide for other people. So I don't know everything. I don't claim to know everything. And I'm probably, if any of us get into a one-on-one conversation and you ask me a question, I'm probably going to tell you, I have no idea what the answer is to your question, but I'm going to work really, really hard to try and, figure that out. And I'll get back to you, because I know somebody in my network is going to have that answer. So that's who I am. I guess we'll go a little bit into what we're doing with Royal Insurance. We're not trying. We are the one-stop shop for all of your insurance needs, right? So we get in, we do an insurance consult, and we take a look and make an assessment on your entire portfolio. And then we take it a step further to start looking at where can we help your financial plan? Where can we help your retirement plan? What about your taxes? Like, let's see what's going to happen with you when you retire with your taxes. There's the statistic. So when you retire, the nationwide statistic is that 99% of people, when they retire, their taxes don't decrease. They actually bump up a tax bracket. And so that's with 99% of people. And so, we try to help assuage those statistics and put you in a better position tax-wise, put you in a better position retirement-wise, put you in a better position generationally. So that's one of our things that we're really good at is helping with your retirement taxes. We also go into sorry, I'm a little bit off the edges today with everything that's been happening. And so I'm just trying to get organized here.
Doing great, Aaron.
Oh, thank you. Thank you. So I guess we should start with Um, I kind of want to make this a little bit of a conversation. So I'd really love it if the group would raise your hand or speak up, or if you've got questions as we go through all of this, like please reach out, send it in the chat, raise your hand, and I'll try to we'll try to make this as informational and fun and not boring as possible. So what can anybody tell me, like, what is happening in the economy right now? Where are we going economically? What's happening inside the country? What's happening politically? What's happening locally with you? What's happening nationwide? Are we coming into a recession? Are we, is it a what's the term? A bull market? Are things growing?
I can answer that.
Yeah, please.
Because I got my crystal ball right here. So
yes, Chris,
it's a magic 8-ball. So just ask it any questions, and it's always right. But yes. No, I'm sorry, I'm being very flippant about this. But I think there's a lot of inflation is real. It's happening. We're at 8-something%. We just had the rates raised by 0.75, and the Fed has basically said that they're it looks like we're going to have at least 2 more before the end of the year, to see if we can tame inflation. And there's no question that they're trying to basically kill demand. I mean, it's understandable to kill inflation. But I think it's just, we've been punch drunk on low interest rates for so long that we're all just kind of freaking out a bit because money's a bit more expensive now. But I think this is really what shows the mettle of real estate investors. You just got to make sure that much more that you have a good deal from the beginning, and that maybe you're not going to be saved by a continually upward trending market. But just, put your big boy pants on and find a good deal from the beginning.
So find a good deal from the beginning. So make sure that you are. So how do you do that? How do you find that good deal from the beginning? Right? Do you spend all your time just searching through Craigslist and hoping that when that good deal pops up, that you have the capital sitting there so that you can go and buy that good deal?
Are you asking for all my secret sauce here? No, I'm kidding.
Kidding.
I am more than happy to,
right?
For me personally, and this might be kind of vague, but it's really about finding things off market and connecting with as many people as I can. And do it, because in my opinion, once you are on the MLS or Craigslist or anything like that, you are competing against a lot of other people, and the inefficiency is just not there. So I am constantly out there looking for value, for beta. And so for me, it's about connecting with others and solving problems together. And, there's quite a bit of marketing, in certain places too, so that we can get the phone ringing. I found some luck with Google Ads, for instance, buying, older houses and getting, people to commit before they get on the market. It's about being creative. I mean, if you have somebody who wants to sell their house, but they don't have something else yet, they've got a ton of equity in there, but their house is a complete mess. You can offer something like, hey, we'll trash out your house, take what you want, take your time, close on the property, but have them still in there. But if there's a ton of equity, there's this big pot of gold that's waiting for them to move out. And that solves a lot of problem for some people. I found that to be very successful for years and still right now. But you got to be able to change with the market.
Right. Okay, so people, so networking and solving. That's where we're at, that one. If I'm listening correctly, right?
I got half of that.
Oh, internet. I said, so we're going to solve problems and networking, right?
Yes. I mean, it sounds so vague, and I could get into detail, but yeah, absolutely. If you can solve, I mean, I think we forget that. I mean, if you can solve other people's problems, I mean, I have gotten more partners because other people have screwed up. And it's amazing how many people are very short-sighted and don't realize that by taking the time to develop those relationships and to honor your word, it sounds so basic. You can continue, there's nothing worse to a real estate investor than finding a really good deal, for instance, and the capital that you were going to use all of a sudden disappears on you because that relationship with that person didn't work out, or they just flaked on you at the last minute. And I've been able to get clients just because that's happened to them. They don't want to ever see it happen again. I've never, ever, over the hundreds of deals I've done, ever backed out last minute, if I've already committed to it. Except for one guy, and that's because, well, frankly, he was a criminal, and I didn't find out until before closing.
Well, that's good. Yeah. Definitely don't want to do business with criminals. Okay, so my question is, how do you set yourself up to make sure that you have the liquidity to be able to pounce on those discounted deals, those good deals when they come up?
No, that's an awesome question, and one I could spend an eternity talking about. But really, what it's about is having multiple buckets of capital in which you can reach into of varying expense. And I'll just give a couple of examples. If you have a stock portfolio, you can borrow against that stock portfolio. I'm with Interactive Brokers, and I can borrow over 80% of my portfolio at less than 2%. Interactive Brokers. I've been with them for over 10 years. If anybody can tell me someplace cheaper that I can keep my stock and can borrow for cheaper or borrow more against my portfolio, I am all ears. And I've constantly searched, and I found nobody who can get me better than it. So I'll use that for real estate deals and then pay it back.
And that is a fantastic source of money. I've got one question about it, though. Are you protected from market downturns?
Well, yes. Yes and no. I mean, there's risk in everything, right?
Definitely.
And, your traditional margin account is limited to 50% and usually is in the high single digits, whereas this one I can go up to 80%, but I just don't go up to 80%. And, so I have some wiggle room if there's a down market. I also will typically have more expensive money elsewhere that if the market does go down, I could borrow against that source, pay it off, and I don't have to worry about a margin call. Never had one.
For sure.
So
margin calls is not
fun. Could be a HELOC maybe against your house that you don't use. That's another good source. You might have friends and family that are dying to invest with you, and that can come along. There are multiple sources that you can, or hard money lenders can be good, except that can be kind of slow. So just be careful with that.
Okay. Tell me so basically what I'm getting at is why aren't we talking about cash value insurance?
Why aren't we talking about cash value insurance?
Yeah. Why is that not an option for you?
Fair enough. I've looked into it, and I can give you my opinion, and it's solely my opinion.
No, and I would love to hear your opinion, because a lot of the stuff that we look at let's be honest here. I'm an insurance salesman, right? Right. And I'm not going to push you into anything that doesn't make sense. And I'm not going to also, it's just another tool in your toolbox, right? Do I want you to put all of your money in that basket? Absolutely not, because that's foolish. Right.
I think it's a very fair question, and I'll give you my honest opinion of it, is that, as an investor,
yes,
you can't control the market. It goes up, it goes down. You can control your risk to a certain degree. But one thing you can at least try to focus on is reducing your fees. And I have found in the whole borrow with, life insurance, borrow against it, that two things happen typically. One,
Right.
the amount of money that you pay to do that is high, in my opinion.
Okay.
And the returns on your invested money, I have found, are subpar. So
Okay.
I just don't, I mean, and also for somebody like me, I don't know how to say this without sounding pompous. I'm very disciplined. I know sometimes those kind of vehicles that you're talking about can be good for people that are not as disciplined, where they're automatically putting money into it over and over again. It just doesn't, I mean, I'm all ears. And if you want to talk offline or online about it.
Oh yeah. No, like Chris, I would love to get you into a meeting with my guy that, like, this is all he does all day long. He works with dudes that are huge money worth, you know, like, I mean, and so basically with the insurance, it's all about mitigating risk, right? With those cash value policies, and saying, okay, I can protect myself from market downturn because they have zero, like they have a floor. If the market goes negative, my money doesn't go negative.
Right.
Yes, they're not going to have the kind of returns that your other investments have, your stock and your mutual funds. They're not going to be as high, but there's that trade-off. They're never going to go negative. And I mean, I'm not nearly as good at talking about it as he is. And so I really, I don't want to put my foot in my mouth on it. Right. But,
it's just you and me here.
Oh yeah. I would love to like, and anybody, like, I would love to get everybody into a meeting and show what we can do with this insurance. Cause it's just another tool in your toolbox, right?
Mm-hmm.
It's another way. Sorry, go ahead.
I'd like to hear about that too. I think a lot of people probably would be interested in hearing how that works and what you have to offer.
Yeah. So like it's with your cash value insurance policies, you can go, they have that 0% floor. So your money doesn't go negative, which is really, really neat. Your annual returns are normally in the 6 to 8% range. You can borrow against them. So you have that instant liquidity in case those, discounts like we've been talking about come up in the market. And they like,
correct.
They're just another tool, right? Like we should have access to all of our tools. And for some people, they don't make sense. Like I totally understand where Chris sits and he's like, I just don't see it being as valuable as I would want it to be.
Well, and to be fair, that's just my current, my current thoughts on it. I am willing to listen to anybody, and I'm looking for yield wherever I can.
Right.
I just feel as a long-term investor myself, I can pay a lot less fees, get a higher return over time. But for a lot of people, they don't have the risk tolerance that I do. In 2008, I sold nothing. And I know a lot of people who panicked and sold everything. As a matter of fact, a lot of gurus that I listen to, try to do the whole, I'm just like you. I lost, so much money in 2008. And I'm like, you've lost 30% of your portfolio in 2008. Why am I listening to you? Sorry, I'm going off topic here, But no, for the right person, it can be a wonderful vehicle. And there's also the side benefit, which I don't have within my investments, of having a life insurance, part of it if something would happen to you. And
right. So, I mean, there's always that death benefit right there. And that's, I hate talking about death benefits. I hate talking about
why it's a reality. I mean, I appreciate
it is a reality,
saying, but it's a reality. I mean, especially if you've got kids or you got a wife and you're the sole breadwinner and you don't have a ton of assets, you are doing your family a disservice by not having some kind of life insurance. Just think of if you passed away, do you want your kids or your wife on the street?
That's very true. I mean, you should be my salesman.
But that is something that people should take very, very seriously.
Chris, do you want to come sell insurance for me? But I mean, I totally agree with you. Like, we're all going to die. We're all going to, you know, and we're all going to leave somebody behind. And what position do we want to leave them in when we pass on? When we, you know, and so, I mean, the life insurance bit, the death benefit, like you can set yourself up to be that generational wealth so that you're not only passing on to your kids, but your grandkids and your great grandkids and your great great grandkids. And that whole it takes money to make money thing is kind of real, you know? So I want to jump back to that bit that just to the comment that you made about all of these investing gurus, right? And they come on stage and they say, I was in the 2008 bubble just like you, blah, right? At 2008, the market lost 42% in 7.5 months. And it took until 2015 to break even, right? So to come back from 2008, it took 7 years to get back to where we were in 2008. The market. Now, some investors did better than others. Some people didn't go behind at all. And that just goes to show that you've got, you know, you're on top of your plan, right? You're using all of your tools that you have. Those guys that have
more than anything else, it's a matter of discipline. You know, it's human nature to want to sell when things are down and buy when things are really expensive. But you got to learn to not do that. And as a long-term investor, I mean, look, I have a lot of ability for risk. I can tolerate it.
Yes.
Whereas a lot of people can't, especially in real estate. I find there are a lot of people who want nothing to do with the stock market that are heavily involved in real estate. I sometimes feel like I'm on an island that I just chase yield. I'll take it wherever I can get it. I'm a full-time investor who just happens to be predominantly invested in real estate. Sorry if you guys can hear it. There's a vacuum going on downstairs. So that's why I'm going on and muting and going on. But I find that, you know, over time, I mean, the market does a solid 11, 10%, you know, over decades. And
yes.
Look, if I were older, I probably would want to reduce my risk even more, and these products might look even more competitive. But you know, it's not even. But when I also consider the fact that I don't pay any fees, you know, for the stock portfolio, and when I borrow against it, I pay very minimal, you know, less than 2%, you know, in terms of interest. I find with this. And you're probably gonna hate me for using this word, but you know, infinite banking or any of its offshoots.
So price, I hate that term, infinite banking. It's garbage.
Yeah. But it's similar. And look, I'm happy to talk, you know, numbers and percents, but I just find, you know, it's these insurance products are very expensive when you consider how much it costs to put your money into it. I'm sorry, it's just my conclusion.
No, I get it. And I would love to, well, Chris, you and I are definitely, I'm going to get into your calendar and we're definitely going to have more of a longer, like more in-depth conversation. And I'm going to change your mind, maybe.
Okay.
Maybe.
I look forward to it.
Maybe.
No, I look forward to it.
Okay. So the next bit of like insurance is about eliminating risk right? Like that's the whole name of the game, is eliminating risk. Or not eliminating it, but putting it on to somebody else, reducing it, right? So one of the things that the life insurance that gives you is statutory protection from bankruptcy, from divorce, from other Those are like the two main ones. If you get divorced, your money inside of your life insurance policies are, and this, I mean, you know, I'm hoping that none of you get divorced.
But it's a reality. 50% of people get divorced. That's true.
Exactly.
It'll never be me. My wife.
But your money inside of the.
Sorry.
Yeah.
I'm gonna use a joke that my wife and I use all the time. We'll never ever get divorced. Murder maybe, but divorce never.
Well, you know.
Clearly, if I can say that on a recorded camera, it's never going to happen. Probably not.
Well, I just said it, so it's fine.
She's right behind me.
Yeah. I bet she's just sitting back there smiling too.
She is. She uses the same comment. She's more likely to kill me. She's the physician. She knows how to kill me without anybody else knowing. So I need to be careful.
Yeah, I imagine Julie has a question or has a comment.
Yeah, I just saw that. Thank you, Alex. Julie, you've got a question for us.
Yes, Aaron. I do have a question regarding the whole life insurance. I understand that there is the cash value part and there is the death benefit part, and the cash value is growing and they're paying dividend to offset the inflation. However, I'm not sure if the death benefit also grows in the amount, because let's say if I have a 1 million death benefit right now, after 50 years, that 1 million is not a lot to pay for my kids and all the expenses. So do you know if the death benefit amount will grow in time or it's fixed?
Yeah, so that's a great question, Julie. Both. The answer is both. There are policies that have a flat death benefit, and then there are policies that have a death benefit that grows over time. It just entirely depends on how we set up the policies. And they usually the policies that have a flat death benefit, most of the time, those are term policies, meaning that at the end of the term, 10, 20, 30 years, your death benefit goes away because the term ends. There are some whole life policies that are a flat death benefit for the first 30 years of the policy, and then after 30 years they will grow. And then there are some that they grow from, I'm not 100, I've seen them, but I'm not like 100% positive what they are, but I have seen them where they grow from day one. It just entirely depends on how the policy is set up. And I completely agree. $1 million in 50 years, very likely could be like $1,000, with inflation, with everything that goes on in the world. I don't know what it's going to be, right? When our parents were 50 years ago, they were buying houses for $20,000. And now that same house could be $1 million, right? So the inflation in the real estate has just been insane. So who's to say what's going to happen there? I don't know, but I know that I want to be protected. Let's see. Robert Vale just mentioned something here in the comments that I wanted to touch on. It doesn't like there. So Robert, with the not getting a whole life policy that doesn't increase, it's all based on what tool, because the policy that has a non-increasing value, death benefit value, is going to do different things inside of the policy than what your increasing one does. So a policy that, let's see, $1 million in whole life coverage will end up costing somewhere between, for an average person, okay, these are all average numbers, but for a whole life policy, somebody that's 35 goes and buys a whole life policy, pays on it until the day that they die, it pays out $1 million. That policy is going to have costed them somewhere between $300,000 and $400,000 over the course of their life. So it's their money compounded, 2.5, 3 times, 3.3 times or so. So the cost of it is somewhat low. I did a policy illustration for a gentleman the other day. He wanted to put $50,000 into his policy the first year. And then for the next 10 years, he put in $10,000 a year in premium. So all in, he put $230,000. The gentleman was 56 years old right now. By the time he was 90, if he lived to be 90, his death benefit was worth just shy of $1 million. And that policy on day one, after starting the policy with that $50,000 in year one, he was able to borrow $42,000 of it. And so that was something that worked for him. But then we also have, if all we're looking at is the death benefit, and you're in a position where it's like, okay, I don't want a whole life policy. I want a term policy. Let's take a look at, there's term policies that have, it's called a return of premium. And so you pay into the policy for 20 years to keep it active. And at the end of that 20 years, the insurance company will give you your money back. The premium that you put in, they give it back. Now, it's not an investment because they don't give you extra money, but they do give you the premium that you put into it back. So that's kind of cool. It's instead of renting a house, you're kind of almost like a sublease, right? Because you get your money back, if that makes any sense.
Can you borrow your death benefit like a reverse mortgage?
Depending on the policy, yes. Well, no, you can't borrow against the death benefit. You can borrow against the cash value of the policy. They're different. And Julie, I would love to talk to you about it. Like we can get an appointment set up, and I can show you what we can go through on those for sure.
Yeah. If someone doesn't have heirs, is it still worth of getting a whole life insurance?
I didn't catch the beginning of that question. Could you repeat it?
If someone doesn't have heirs.
So that's going to depend. What do you want to happen with your everything that you own when you die? So if you don't have heirs, maybe that death benefit isn't really what's important to you. Maybe you want to structure like what's happening with all of your assets. Where are they going? Who's getting those distributed to? And are they just going into the ether, or are you giving it to family members? I think all of us in a way might not have children, so we don't have what we consider traditional heirs, but when we leave, there's still that legacy that we want to pass on to somebody.
That's why I'm asking if someone can borrow their death benefit, just because when someone is reaching their 80s or 90s, maybe they have a huge expense for medical, or they have to go to nursing houses. And then, because the insurance company has to pay out the death benefit anyway, so they might want to, let's say, take 80% of that death benefit and just pay off for the seniors to take care of them at their final days.
So there is I'm not 100% sure exactly what the product is or is called, but there is companies that will actually, you assign them as your beneficiary, and they will give you and they will give you a loan against your death benefit. Yeah. So
you
it's
sell
not
your death benefit at a discount.
Exactly. Yeah.
Got it. Okay.
Yeah. And I know that those do exist. I can't remember exactly what they're called. If you want more information on it, I can definitely get it and send it to you. But yeah, if the money's there, the insurance company contractually has to pay it out, right? They can't not pay out on a life insurance. As long as we, the policyholder, held up our end of the contract, if that makes sense, right? Yes. That's one of the things that we're focusing really, really hard on with the liability insurance side, in making sure that our assets are properly protected, right? We've had a bunch of clients lately that their insurance policies on their rental homes are improperly done, and so when they've had a claim, and the insurance company denied the claim, right, because they weren't set up properly, which made the insurance company say, sorry guys, you didn't hold up your end of the contract. So, I want to make sure that you're always holding up your end of the contract, so that you can collect when you need to. Let's see, Robert, correct me if I'm wrong, but technically the cash value portion of the whole life policies are part of the death benefit. You can borrow against the cash value portion and never pay it back, and it will be subtracted from the death benefit when it is eventually paid upon the death of the insured. That is exactly correct, Robert. Yes. So when you borrow against the cash value of a policy, it costs you a couple of percentage points. And even in the illustrations, they won't tell you exactly what it's going to cost. They'll say the lowest cost is 0% and the most expensive is 8%. We have a few clients that are currently borrowing against their cash value, and it's right around 3% that they are paying. I haven't done one in the last 2 months, and so I don't know what I don't know if the raising of the rate these last couple months has affected. I don't know where it's sitting, but that's the way that they have it set up right now. But yes, you're very right. So you're borrowing against the cash value of your policy, and you never have to pay it back if you don't want, because that money is going to get paid back when you die, by the death benefit. So I borrow $250,000 against my $1 million policy death benefit. When I die, my heirs get $750,000. The $250,000 goes to pay back that loan that I took. And let's see.
I'm in California. Is it worse to have earthquake insurance?
Is it worth having earthquake insurance in California?
Yeah.
So here's the best answer that I can give you. It depends on your ability to recover financially if you were to experience an earthquake that was that damaged something that needed repair. Right? So are you in a position to where you can pay for any damage that may happen? Or if you were to have an earthquake and your foundation shifted and your house, it was a, say $50,000 bill to fix your house, would you be able to from that?
That's unknown.
Like
Depending on how big the earthquake is.
That's exactly right. And so that's the risk that you're going to take on personally, right? Liz just brought up a thing, and she said, as an insurance agent, I can't say you don't need it because that leaves me open to liability, which it does, which is one of the reasons why I have to carry a huge amount of errors and omissions insurance. But talking to you straight, you are going to choose your risk. I am not going to tell you. Yeah, I'm not going to tell you you have to have this. The bank's going to tell you have to have property insurance. But me as your insurance agent, I'm going to say, here are your options. Here is what best practices are. You now need to take that information and make a choice as to what you want to do. Because when it comes down to it, it's your choice. It's not mine. It's not, your children's. It's not your best friend. It's not your church pastor. It's your choice what you're going to do. And so you are the one who is responsible at that point. If that makes sense. Both Brendan and Chris both say they're not fans of earthquake insurance. Brendan said in California earthquake insurance, his take is a no. Premiums are high, deductibles are high. I would rely on a federal disaster fund and emergency loans for restorations. The government has an interest in keeping people housed. And I'm not going to disagree with that. We can take a look at what happened in Louisiana with Katrina. I can't remember what percentage of the city was lost, but it was a huge percentage, right? And most of those people did not have flood insurance, but yet they've rebuilt that city. So it's kind of a toss-up, right? They've rebuilt the city, but at the same time, I know a lot of people that were drastically hurt from Katrina financially. So yeah, it's a earthquake insurance is a tough one. Another one that people have a hard time with is flood insurance. They don't know whether they should have flood insurance or not. I live in a desert. I live on a hill. Do I really need flood insurance? It's as your insurance agent, my my generic answer is always yes, protect yourself. But at the same time, it's your risk that you are going to take on. If that makes sense.
One last question. I heard that even if you have fire insurance, if it's wildfire that's caused by nature, insurance company doesn't really pay for that.
So that it comes, my understanding of it, and I don't have a perfect understanding, but my understanding of wildfires is that it's a separate rider. So most of your dwelling and fire insurance that you have on your rental properties are for arson and electrical fires that start inside of the home. If the fire comes from outside of the home and burns down the home, it is an extra rider that you put on. But that's only from some carriers. Some carriers include it, some carriers don't. And so that would be one thing that you might need to look at depending on where your house is located. And something that maybe you want to think about. So let's see here. Oh, it looks like we're kind of out of time here, but Megan had to hop off. My email is in the chat. You can email me directly. If you go to the RLS website, there's meeting links there. You can book a meeting with me. My calendar, I've got lots of space in there. And if I don't, then I'll just open more up. And we can, discuss whatever needs to be taken care of. I'll even, my email, my direct email is royallegalsolutions.com. Aaron, AARON at royallegalsolutions.com. I'd like, by all means, send me all your questions and we'll see what we can do for you guys. All right. Okay. You guys all have a fabulous, what day is it? Wednesday. And I look forward to talking to all of you soon.